Welcome to the debate from MacroSpire.com. Before we begin, this content is for informational and educational purposes only. It is not financial advice and should not be relied upon for investment decisions. Past performance does not guarantee future results. Always consult a qualified financial advisor. Today, the Contrarian and the Hawk go head-to-head on Nike, the $67 billion overreaction you should buy. Let's get into it. Wall Street just handed you Nike at $45, a price we haven't seen since the Obama era. They beat earnings by 25%, wholesale is growing again, and the market's acting like the company is going bankrupt.
They beat a bar that was lowered into the floor. Net income collapsed 35%, gross margins got destroyed by 300 basis points from tariffs, and forward guidance was awful. Beating 28 cents when you're guiding down is not a victory lap.
But that's exactly my point. The guidance miss is about tariffs, not about the business. Tariffs are a policy decision that can reverse overnight. Nike's brand positioning and market dominance don't evaporate because of trade policy.
Sure, tariffs can reverse, but when 50% of your production is in China and Vietnam, a 300 basis point margin hit isn't just noise. That's structural until they physically move supply chains, which takes years and costs billions.
Nike's been diversifying manufacturing for a decade. And let's not ignore that wholesale revenue grew 5%, that proves Elliott Hill's channel rebuild strategy is actually working.
Wholesale grew 5% because they're fire-selling inventory through partners after the DTC disaster gutted their direct relationships. That's not strength, that's desperation with lower margins.
Come on, rebuilding wholesale was the explicit strategy. They over-rotated to DTC, Hill recognized the mistake, and now they're fixing it. You can't call the fix a problem.
I can when the fix comes with a 35% earnings decline. Look at the cash flow, that tells you the real story. Operating cash flow is deteriorating, and they're funding buybacks and dividends while the core business bleeds.
The dividend alone puts a floor under the stock. Nike has raised its dividend for over 20 consecutive years, and at these prices the yield is the highest it's been in a decade. Add the buyback program and you've got significant shareholder support.
A dividend floor only holds if cash flow supports it. If margins keep compressing under tariff pressure, that dividend becomes a trap, not a floor. You're paying shareholders with deteriorating fundamentals.
Nike generates tens of billions in revenue. They have the balance sheet to absorb a temporary margin hit. This isn't some overleveraged mid-cap, it's one of the strongest brands on the planet trading at a multi-year low.
And it's at a multi-year low for a reason. The valuation still isn't cheap enough. Even at $45, you're paying a premium multiple for a business with shrinking margins and no credible path to recovery in the next 12 months.
The valuation gap versus peers is absurd though. Nike's trading at a discount to companies with half its brand equity and a fraction of its global distribution. The market is pricing in permanent impairment that simply isn't there.
Or the market is finally pricing in the reality that Hill inherited a mess. The DTC over-rotation destroyed wholesale relationships, inventory is bloated, and now tariffs are squeezing what little margin recovery they had.
Hill has been CEO for barely a year. You're judging a turnaround before it's even had time to take hold. The playbook is clear: rebuild wholesale, reinvest in innovation, restore the brand. That doesn't happen in 2 quarters.
I agree the turnaround needs time, but tariffs just stole that time. You can't execute a multi-year brand rebuild when your gross margins are getting crushed every quarter. The runway just got a lot shorter.
And what about the macro setup? We're heading into a rate cut cycle. Consumer discretionary stocks historically outperform when rates come down, and Nike is the highest quality name in the space at a bargain price.
Rate cuts help if consumers have confidence. But tariffs are inflationary, they raise prices on exactly the products Nike sells. So you've got a consumer squeeze from higher prices at the same time you're hoping they spend more. That math doesn't work.
Nike has pricing power that most brands would kill for. They can pass through costs better than almost anyone in the sector. The swoosh commands a premium that competitors can't match.
Pricing power is great in theory, but they've been discounting aggressively to move inventory. You can't claim pricing power and run clearance sales at the same time. The brand heat just isn't there right now.
That's the short-term inventory flush to reset the business. Every turnaround has an ugly middle chapter. You're looking at the transition costs and calling them the new normal.
And you're looking at a $67 billion market cap after an $11 billion wipeout and calling it a bargain. The inventory trap is real. If they can't clear product at healthy margins, the write-downs compound.
So what would change your mind? Because if wholesale keeps growing and tariff policy shifts even slightly, this stock rips back to $60 in a heartbeat.
Show me 2 consecutive quarters of gross margin expansion, stabilizing DTC revenue, and inventory days coming down. Until then, the turnaround is a PowerPoint, not a reality.
Fair benchmarks. But by the time you see all three, the stock will be at $70 and you'll have missed the move. The whole point of buying Nike at $45 is that you're getting paid to take the uncertainty.
Or you're catching a knife while tariffs are still escalating, margins are still compressing, and the CEO's turnaround plan hasn't produced a single clean quarter yet.
Bottom line, Nike at $45 is a generational brand at a generational price. Tariffs are temporary, the turnaround is real, and this stock will double before the bears admit they were wrong.
Bottom line, the tariffs killed the turnaround timeline, the fundamentals are deteriorating, and catching a falling knife with a 35% earnings decline isn't contrarian investing, it's wishful thinking.
The contrarian, the hawk, thank you both. What do you think? Let us know in the comments. Read both articles in full at MacroSpire.com. Thanks for listening to the debate.